to Nirmal Bang, ladies and gentlemen. I'm Hiral Datia. We have with us Mr. Chakri Lokpriya, MT and CIO at TCG Asset Management, joining in. Welcome to the show, Chakri, and always a pleasure to speak to you and pick your brains as well in terms of what could be expected with all of this around. Chakri, my first question coming to you overall is, if you see in terms of what's happening in the global markets across, what is your read, especially in terms of, inflation, growth rate hikes, the liquidity squeezing, and its impact in terms of the Indian market?
Hello, and thank you for having me. It's always nice to have an interesting conversation with you. And I think we are today at a juncture where, the world economy, including India, was coming out of a pandemic-induced economic slowdown. And the expectation was the economies will revive and therefore growth rates will go up much faster. And that was the expectation until about the end of February, March of this year, when suddenly the war broke out between Russia and Ukraine. And at that point too, initially the central bankers around the world, including India, expected it at the highest levels for it to be a short conflict and some resolution would have been in sight. Suddenly now, fast forward 3 months later, 100 days into the war, it's become fairly evident to the central bankers, as evidenced by the emergency move with which RBI moved up the interest rates by 40 basis points the first time around, to counter in anticipation of the increase in interest rates around the world. Why has interest rates around the world suddenly moving up very fast? Because of inflation. And now what caused that inflation is high oil prices. What caused high oil prices is because of supply disruptions due to the war. So therefore, usually in a economy, when the demand goes up very strong, it leads to supply mismatches, and therefore central bankers raise rates to cool down demand. But this time around, demand was never really high. The world was coming out of an economic slowdown due to the pandemic. There was some amount of supply chain disruption already because of the pandemic. On top of that, once the war started progressing, oil doubled, went up about 70% from about $60, $70 to about $120, which has led to a huge amount of inflation. Now, to counter inflation, central bankers don't have much tools. They're raising interest rates. That will lead to a destruction of demand. And therefore, all the economic forecast of growth, I think, will likely come down if the war resolution is not in sight.
Right. So with all of this said and done, as you mentioned with regards to, the supply disruption that we've already seen, how do you see in the current situation things improving? Do you think it's going to be a slow process, or do you think it's something which will really take long to normalize?
Now, if you look at the past wars which led to high oil prices, even in the case of the Iraq war, US-Iraq war, at that time oil prices did shoot up. The day they announced the end of the war, very quickly oil prices went down dramatically. And if you rewind back just about a few months ago, maybe January, February of this year, oil was only about $60, $70 From there, it's gone to $120. So in this environment where as long as this uncertainty of how long it continues, there will be a uncertainty of both the consumer to spend and the corporate to do capex. So, and therefore the growth rates will slow down. I think that's the environment that we're looking at in the short term.
Right. So with, the way the global situation is, what would your advice be in terms of the markets? Because clearly, if you see, we are seeing major dips coming in, but there is some bit of consolidation after every dip. So do you think this is the time to buy on dips or buy the fear? Or would you say best thing, stay away for some time now?
Whatever you're already in the market, really stay. But incremental buying, I would wait by the sidelines and just watch, for where the oil prices are moving. Now, in case of oil and commodities start moving up from the current $120 a barrel, then clearly stay away from the market because it causes further inflation, which will be higher than expected, leading to faster destruction of demand. On the other hand, as if one sees the inching down of commodity and oil prices, it is clearly time to start accumulating and coming to the markets. I think that is something which we need to wait and watch over the coming couple of months.
Right. And overall, if you see in terms of the markets from here as well, where do you see it moving from here on?
See, what has happened is in the last 2 months, suddenly interest rates both in India and outside India have dramatically moved. Normally interest rates go up in a step function of maybe 25 basis points. Now, instead of that, you had each move costing 50 basis points to 100 to 75 basis points. So it is clear that they're trying to place sudden brakes on a weak economy to begin with, because supplies are not out there. So then in that situation, what is necessary is clearly look at, portfolio managers need to rejig their portfolios towards more export oriented luxury items, etc. And I think that is the name of the game now.
Right. So overall, what sectors would you look at from this perspective? Because with interest rate hikes in India, a lot of demand will be impacted as well, especially when you look at real estate or the consumer discretionary space. How are you seeing these sectors?
Now, if you clearly look at real estate, as you mentioned, interest rates have moved up in India, which means EMIs for the consumers will move up. Mind you, India as a country has 90% of its EMIs are on floating rates. So it's almost immediately the EMIs will go up. And so that reduces the amount that they're earmarked for other purchases now will go towards paying the EMIs, therefore reducing the customer's discretionary power. So clearly real estate, I think incrementally one needs to avoid. On the other hand, we're focusing on luxury makers or smaller consumer discretionary items would still be a good place.
Right. And overall, if you see in terms of the sectors to avoid and sectors to buy, where would your bets be currently?
See, if you look at now, it's a time for one is, of course, bottom-up stock picking. In addition to that, if you look at the luxury goods we mentioned, now come on like hotels, or in the hotel sector, you have companies like Indian Hotels, Chalet. Now, these are companies like the Taj brand and the Marriott. So these are the higher end luxury brand where the spending is unlikely to come down because of high inflation. So that's clearly space to buy. Companies like Tata Motors or sectors like Tata Motors, which have both an export income, a foreign income revenue as well as domestic. On the other hand, because of high energy prices, the energy sector will do well. With India economy slowly picking up, despite all those problems, the power demand is picking up. Therefore, power sector is something you should look at. Being locked up for the last couple of years and now coming out because of easing of pandemic, smaller ticket, the consumer discretionary items, companies like Voltas, going out to the movies, Inox, PVRs, those are the ones to look at. Then what do we avoid? We look at companies which are import dependent because with falling, it increases the cost of imports and lowers profit margins, or where there are very high input prices, like for example, the cement sector, where high commodity, high coking coal prices will clearly bring down their profit margins.
Right. So these are a few of the sectors and picks that we should avoid and buy. And overall, if you see in the market range as well, that's a pretty tight range that we are seeing. So from a medium to long-term growth story, where would your bets be? Because clearly a lot is dependent on what's happening in terms of oil prices go, because a clear domino effect in terms of inflation, in terms of growth, and anticipation that yes, if import related companies are to be avoided, exporters are the ones who could be beneficiary as well. So how do you see that scenario panning out?
You're absolutely right in terms of, because if import is hurt, then export will benefit. And so information technology as a sector, now that sector has corrected along with the market, more than the market, due to collateral damage, because the Nasdaq has come down. But the Indian IT companies are very different. So they are services companies versus product companies in the US, which have come down. So, and today with the right frontline companies like TCS, Infosys, all down 20-25% in just last 2-3 months, and their demand is perfectly intact. Their export revenues, and furthermore, they will benefit from a fallen rupee. It adds to their margin, and therefore, I think that's a sector to look at. And clearly, these will be much higher in about a year from now.
Right. And with all of this said and done, one stock, Chakri, that you were betting big on is with regards to a Tata Motors. With the lockdowns that we are seeing in China, do you see a concern, or do you think it's still a company that we should keep looking at?
Tata Motors is it's a very unique company because it has a domestic business. It has manufacturing plants in India making cars, trucks. It also is a foreign company in the sense it has factories outside India manufacturing Jaguar and Land Rover. And second, it makes both domestic cars, which are for the common consumer, and then it makes JLR, Jaguar and Land Rover, which is a luxury item. Then it has petrol, diesel, the regular ICE engine cars, vehicles on one hand, and on the other hand, it is one of the front runners in the new emerging space of electric vehicles. So this unique combination of having, and it has both the passenger vehicles as well as consumer commercial vehicles. This kind of a combination is very hard to find, whether in India or outside of India. And if you look at Tata Motors, debt levels has been coming down, and they partly because of supply chain disruptions, there's been an increase in working capital, which will normalize over the next year or two. The Jaguar Land Rover lineup of new Range Rovers, new Defenders, which are luxury cars, therefore their demand will not be impacted, is looking very strong. China's lockdowns, in fact, if you look at Tata Motors itself, their sales have picked up from the previous months as lockdowns ease. And third, Europe and US for Jaguar Land Rover environment is very strong. And it has a combination of good petrol, diesel, as well as EVs. Because, end of the day, EVs, while it's a fast growing segment, is not going to happen overnight. And therefore, they have a good strategy of managing both EVs and things. If you put all this together, I think it looks to be a very good company to buy for the medium and long term.
Right. So that's with regards to where Tata Motors go. Secondly, in terms of the recent listings, say for the likes of a Zomato, Delivery, Paytm, Nykaa, what's your view? Because all of these, at least in terms of when the companies were listing, there was a lot of hype ahead of. We have seen some cooling off. So what do you make of the valuations? And do you think this is the time to purchase, or do you think it's best to avoid?
Okay, that's a very good question in the current context. But if you look at all the companies that you mentioned, Zomato, Nykaa, Paytm, all these are meant for the common consumer largely. Yeah, a person wants to order food, a person wants to pay on a Paytm, or they want to buy a cosmetic of Nykaa on Zyka. So what happens here? Now, because of high inflation, expected further inflation high, and a dent in the common consumer's wallet, that will hold back spending on discretionary items. So which means all these companies, they all serve, whether it is a Zomato delivering food or a Nykaa in cosmetics, these are all discretionary items which people will cut back. The common person will cut back, not the high end of the range, but the common and the mid end of the range.
Right. And very lastly, Chakri, overall in terms of fair markets, you've told us Tata Motors and RIL continue to remain your top picks. However, in terms of the Nifty as well, how do you see in terms of the levels to watch out for? And do you think there could be major downgrades?
See, if you look at the Nifty overall today, going into FY23 and 24, you're expecting north of 15% growth in earnings of the Nifty. And this is, mind you, there have been some downgrades in the last 2-3 months, taking into account the high oil prices, etc. And against that backdrop, the Nifty is currently trading at about 15 times FY24, which is not an expensive number. So as long as the growth remains intact, I think we are kind of more or less in a fair market zone. And on the other hand, if oil price fall, then the market looks uniquely undervalued at the current point in time.
Right. So those are views that we should be picking up as well. Thank you, Chakri, so much for joining us on the show. Always a pleasure to speak to you, get insights from you. Thank you. Stay safe and hope things improve from here on for all the investors as well.
Thank you.
Thank you, Chakri. Thank you so much. Bye.
Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.